Good afternoon and welcome to the BetaShares webinar, Investing at Different Life Stages. Thank you for joining us today. I hope you're well. This topic was actually voted on at our last webinar, an introduction to ETFs, as something that most people would be interested in hearing about. So we're pleased to bring it to you today. Also, whilst I'm pleased to be guiding the conversation, really pleased to be joined by my colleague, Adam O'Connor. Hi, Adam.
Hi, Sarah.
Some important information. We will be talking about ideas and concepts that are general in nature. We don't know your personal circumstances or objectives. Use this webinar as part of your research and information gathering process. Before making any investment decision, we do recommend you source relevant copies of the PDS and fund information from our website, and you can speak to a financial professional. Any reference to past performance are not indicative of future performance. So before we start, a recording of the session and the slides will be sent to everyone who registered. Whilst we have literally received hundreds of questions during the registration process, if you do have any that pop up during the session, pop them in the question widget and we will try and get to them as well. We've built the session to try and answer as many of those questions as we can and tried to make it relevant. But again, if any more questions do pop up or you think of anything that springs off what we've put together, write it there and we'll try and get to as many as possible. So just moving along, this is us. I'm Sarah Hare, Senior Marketing Manager here at BetaShares. And as I said before, happy to formally introduce Adam O'Connor. He's a director in the business and works across the capital markets and advisor services. Right, with the introductions and admin out of the way, Adam's going to lead this part. Adam, can you give us just a quick recap on what an ETF is?
Sure, thanks, Sarah. Good afternoon, everyone. Look, as we spoke to last time, for those of you that missed it, they can find that on YouTube now, can't they, Sarah? But I do highly recommend going back and having a watch of the first in this series if you're trying to get a bit of a handle on what an ETF is for the first time. But an ETF is just a managed fund where you can enter and exit the fund by buying and selling units on the exchange, as opposed to the traditional managed fund structure that requires you to submit a form with the fund manager directly. Most ETFs that we talk to are index funds, and what that means is they are just trying to replicate whatever index they track. That could be the Australia 200 or the S&P 500 or any range of indexes that you can create which invest according to stated set of rules. You can also have active ETFs, which have a portfolio management team making decisions on which securities to have in the portfolio at any given time. The point we try to, I guess, leave investors with is just that an ETF is simply a managed fund structure. The way we describe it, which you would have heard us talk to last time, is just a progress in technology. And so that enables investors to enter and exit the fund simply, quickly, by trading units on the exchange, rather than directly with the fund manager by submitting a form. You can see here on the next slide, the range of ETFs now readily available to investors. Some of these have been in asset classes that have been quite difficult to access for investors, be that international equities, fixed income markets, or even things like specific income focused strategies or managed risk strategies, which I'll talk to a bit later on.
Okay, great. And you've split the session up into sort of three general areas that people either have, life stages, or as they think about investing, just three sort of stages of that.
Yeah, so we'll talk to some things to think about when you're starting your investment journey. Maybe you're looking at your first investment portfolio, or even the first time investing for yourself outside of super. We'll talk to the accumulation phase of life, which for most people will generally talk to some strategies for your superannuation, which everyone on this call will likely have. And then we'll talk to some considerations for retirement, as you're approaching retirement even, and some adjustments you might want to make to your investment mix and the type of strategies that you might consider there.
Okay, and as we sort of think about any type of investing, what's the first thing to know?
Yeah, so I think before we get into talking to the different life stages and some relevant strategies, I do think it's really important to briefly touch on the concept of a risk profile, which is something you're likely to come across in some form along the way, whether you're managing your own investments or even talking to a financial advisor. Now, a risk profile is used in investment management and by financial advisors to determine your asset allocation. And by that, I mean how much of your portfolio is invested in what we'd call riskier or more volatile assets like equities, and how much of the portfolio is invested in more defensive assets like cash and bonds. And to determine your risk profile, you really need to be thinking about two main things. The first being your investment timeline. So if you are young and you're starting out investing with a longer term goal to grow your investment over time, then what that means is you have the ability really to ride out periods of market volatility and hopefully recover any losses from market pullbacks. And that's what's referred to as having a high risk tolerance. When we talk about a high risk tolerance, it doesn't necessarily mean that you're, I guess, a seasoned gambler who's used to winning and losing. You can actually be quite a cautious person by nature and still have a high risk tolerance for investment purposes. The way to think about it is, does my investment time frame mean my portfolio can tolerate short-term volatility and drawdowns in order to invest in higher risk assets which have the prospect for higher longer-term returns? The other thing you need to be thinking about is what your objective is in the first place for investing. If you need the dividends and the income for your investment portfolio to live off, then your objective may have changed from growing your capital to being more conservative with your current level of capital. And so your risk profile and asset allocation may need to adjust accordingly. Likewise, if your investment goal is to help save for a house deposit, or even you're drawing down on that investment portfolio to pay for private education, you may have a lower tolerance for risk than in your superannuation fund, given you obviously have a shorter investment time frame and you don't want to spend all the money you've saved for a house that you hope to buy in the next year.
Okay, great. And we talked about that high risk and medium, and the risk profile changes as you get older, or can it just change even if you're younger?
Yeah, it can. I mean, this is something we'll talk to about how you need to let your risk profile evolve over time. And this is a good slide, and it just gives you examples of some of the more common risk profiles that we'll see, and the corresponding asset allocation that you might expect. Balance is generally considered 50-50. It might even be, say, 60-40 growth to defensive. Once you get up to high growth, you could be talking to 90% growth or even, I guess 100% growth assets.
Yeah, okay, great. And so now that we've worked out our risk profile and potentially what that blend of assets between growth and defensive might be, let's just jump into actually getting started and some things that we can think about there.
Sure. So look, when first getting started in investing, for the purposes of our discussion here, we're going to make some assumptions that maybe you're a younger investor, and you have a number of things in your favour at this stage of life. The main one simply being time. Time is an investor's best friend, and that's effectively because of what they call the eighth wonder of the world in compounding. compound interest. The longer your investment time frame, the better you can see through what we call market cycles, the ups and downs of market, the volatility, and you can let that power of compounding returns over time grow your investment. On the other side of the coin, chances are when you're starting out, you probably don't have a lot of investing experience. It might seem a bit overwhelming, and you're probably just starting off small, wanting to invest some of your savings, and I guess understanding that you don't really need to necessarily be wealthy to take the first step in investing. From little things, big things grow.
And that's a really good, you just mentioned there, you don't need a large amount to start, and that was one of the questions we received. How much do I need to start? Is there a minimum that I can start with? It's
a great question, and it's one we get quite often. And as I said, ETFs have made a lot of asset classes and investments more accessible. What we've seen in developments in brokerage and the type of platforms and investments options available, that's meant that your transaction costs are a lot cheaper, so you can actually start a lot smaller than maybe you think. There's some great solutions out there. ComSec Pocket, for example, is one. You really don't. You could be starting with something as small as $500 to $1,000.
Yeah, and I think the rule is just start. Once you start, it's often taking that first step for people. So, just some tips, some things that.
Yep.
Sorry.
No, that's all right. I'm gonna drink some water along the way. Look, yeah. So we've got some tips here. This is by no means an exhaustive list of tips. Some of these I'll go through next when I go into a bit more depth in the accumulation phase, for example. But the key ones I want to talk to here are why you should diversify and the concept of diversification, and also why you really need to just keep investing regularly once you start. So I guess talking about diversification. Diversification has been described as the only free lunch in finance. And what it is your best form of risk management. The point around diversification and risk management is that not all investments are going to perform at the same time. Some actually have complementary roles in portfolios. Bonds and equities, for example, they tend to play a complementary role. One's growth, one's defensive. That's why we use them together without getting into the intricacies of it. They typically balance one another out. Bonds have been known to be negatively correlated with equities, and even having a mix of growth equities and value equities in portfolios, and equities from different regions, which all have their own individual dynamics, and some will perform at different times and in different market environments. The other benefit with diversification is not only that it limits the influence of your poor performers in portfolios, but it increases the likelihood of actually holding the winners in your portfolio. And this is particularly a case that we talk to when using ETFs, where you might be investing in whole markets and sectors. Often we'll use the analogy that you're better off buying the dartboard than throwing darts.
And I think that's an interesting point, that diversification, holding different assets that perform differently at different times, and that even can apply to equities.
Very much so.
Okay.
You can talk to a lot of different strategies, but even you're talking a lot about, you can talk about barbell approaches to equity, where different market environments might support growth and different market environments might support cheaper, more value strategies. Using them together can often deliver better portfolio outcomes.
Yep. So just as you consider an international fund and an Australian domestic fund, they won't be performing the same.
Yeah. And you have a lot of different market drivers of returns in markets, and the point is to have a diversified portfolio enables you to just make sure that you're capturing those tailwinds when they happen. The other point, that I want to move on to is just the idea of investing regularly.
Yeah.
If your time horizon is long, volatility isn't necessarily a bad thing. What it means is that with regular investment, you're actually often buying those dips as well as the peaks. You'll often hear the analogy that time in the market beats timing the market. Timing the market is extremely difficult. Very few people can ever do it consistently. And it'll often mean trying to time the market will often mean that you actually miss the best days in the market. And this will surprise you just how costly it can be. I'd highly recommend, there's a lot of articles written online about the effect of missing the best days in the equities market.
Yeah.
I'll give you a stat, and this one's interesting. If you invested in 2010, so this is just looking at the last decade.
I'm old enough to have done that.
Yeah.
Thank you.
If you invested in 2010 and you missed just the 10 best days in the market for the whole decade, we're talking about the US market here. This is where this stat comes from. If you missed the 10 best days in the S&P 500 for the last decade, your total return would have been half what it would have otherwise been 10 years later.
Wow.
So if you go back to the year 2000, hold for 20 years, you get the same result. And this is pretty consistent over time frames, that if you're trying to time the markets and you're moving in and out, you'll often find that you end up with lower returns. So that's just I guess a little bit of an insight into why we say hold for a long time in the market, it's time in the market, and invest regularly, and you'll often get better outcomes.
Yeah, and that plays perfectly to that other point that we've got. Don't be distracted by short-term volatility. We see the news coming through almost, minute updates on what the market is doing. It's really hard as a new investor not to feel a bit of panic or anxiety that I'm losing money and I need to do something.
Yeah, and that's why just being, I guess, methodical and consistent with your process. Understand you're a long-term investor. Understand that sometimes you're going to be buying when the market's high, and other times you're going to be buying when the market's low. But overall, over time, if the market keeps doing its thing as it has done, you'll end up with, growing your wealth over time.
Yeah, and we're in it for the long term.
Very much
that's
so.
What we're thinking. We're just in it for the long term. Another question we had was, and a reminder that again we're not really recommending anything, but what are some investments that you can consider when you're just starting out? So
this is these are the ones that I wanted to talk to. One of the simplest tools for early investors, be that yourself, be that honestly, if we did get a question here around investing for grandchildren,
yep,
or setting up accounts for children, or even just setting up a side account that we spoke to beforehand about paying for school fees.
Yep.
One of the simplest tools for investors to achieve these things is just through a diversified ETF. I guess they're a newer type of ETF that's only been around for the last couple of years, but they're an amazing tool for this kind of thing. So a diversified ETF is an ETF which invests in a number of other ETFs for you. So rather than equities ETF that'll buy underlying equities, this will buy other ETFs that invest further. And they're generally built corresponding to a risk profile, like I spoke to earlier. And so here we've got all growth, high growth, growth, balanced. DHHF is our all growth diversified ETF. We actually have 3 ethical diversified funds: high growth, growth, and balanced. Why diversified funds are particularly good for early stage investors is they provide diversification that I spoke to before across a number of different levels. So you get diversified exposure of having baskets of individual securities in each ETF, but you also get that across a mix of different segments. So you'll get Australian equities and global equities from a number of different markets. And when you're not in all growth, you'll also get asset class diversification between equities and bonds. Importantly though, they allow you to invest regularly and probably manage the biggest cost drains for new investors, which is your transaction costs.
Right.
And so without a diversified fund, if you wanted to build a similar diversified portfolio to what you get here, you need to pay brokerage across all the individual assets, which obviously mounts up. And if you wanted to maintain the portfolio, you'd be paying transaction costs every time you wanted to reweight the portfolio. That's a process known as rebalancing. That's all done for you in the ETF. So there's a number of cost benefits that come into just buying the one fund that does a lot of things for you.
And that rebalancing, reweighting that you spoke to is really just bringing it back into line with your risk profile. If that's a 60-40 growth defensive split, that's simply what that means.
Yeah, and that's what a lot of professional managers will do with a model portfolio. They'll align the asset allocation and make sure that it stays in line with the risk profile you want to have. That can be cumbersome to do on your own and expensive. Mm-hmm. So a diversified fund really manages a lot of the burden for you of managing your investment portfolio as well.
Yeah, okay, great. Now let's move along to the next stage, and arguably the stage where people spend the most time.
Yeah, it's accumulation is probably accumulation can start when you get your first job and your first super fund.
Yeah, right.
And goes all the way through to retirement in various different phases. I guess when we talk about accumulation, we're probably going to turn our attention more towards talking about your super funds, because for most of us outside our homes, this is our biggest pool of invested assets. It's one we contribute 10% of our incomes to regularly, and ultimately with the goal of accumulating a sufficient pool of capital to support us in our retirements. Now, I mentioned before you might have investments outside of super, investment funds for saving for a house deposit or children's education. Many of the same principles I'll talk to will apply, albeit with the individual accounts that might have a shorter time frame. You just need to be cognizant of changing your risk profile and your asset mix as you get closer to actually needing that capital.
Yep.
And your ability to sort of aware drawdowns in advance of that. So I guess moving to accumulation and maybe talking about what we might do, particularly in our super. Many of the key tips that apply to investors starting out with a long horizon that I just spoke to then, they also apply in the accumulation phase, where you obviously have a very long time horizon as well. I spoke to diversification and investing regularly in depth before. The 2 points I thought worth highlighting in addition to that here, we're really focusing on growth and managing costs, and just giving you an insight into maybe some strategies for particularly superannuation funds in accumulation phase. The first one I want to talk to is just focusing on growth. So that can be the easiest way to do that when looking at super is just through your risk profile and making sure your asset allocation is appropriate for your investment horizon, which for someone who may be in their early 20s is a lot longer than someone who's maybe in their 40s. And it's this idea of I guess targeting growth. If you choose your own investment, and I mean, when talking about targeting growth, you can choose high growth, or balance. Choosing high growth perhaps as your investment option with your default super fund. If you choose your own investment mix, it's best to look at equities ETFs aimed at capital growth rather than at income or dividend yield at this point in your life. Now, this is a question we get a lot: is should I be focused on Australian equities that pay franked dividends, for example? And that can be great when you're in a later stage of life where you need the income, but regular income in form of dividends isn't necessarily your biggest priority at the moment. It's really focused on building your capital pool, and so for that, this will often mean looking at international markets like the US. The US tends to have a larger exposure to growth sectors like technology relative to Australia, where our market is really dominated by large businesses that do tend to be more mature and focused on their dividend payouts than maybe some of the US companies that, well, they're called a growth company, which reinvest their profits back into the growth of their business. Amazon's a really good example of that. And that's what we call a growth business. Is, you know, they started out as a digital bookstore, and over time, I mean, they've reinvested in themselves, they've reinvented themselves. They now have Amazon Web Services, which is one of the biggest cloud computing platforms in the world. And so you want to target sort of growth companies like that and have a meaningful allocation to those type of companies in your portfolio, which can be through international markets outside of Australia or different sectors. And lastly, just on growth, is you could potentially look to use dividend reinvestment plans. They enable any distributions received to be reinvested in additional units in the fund, and rather than being paid out as cash. And that can save you a lot in brokerage along the way, which we just spoke to be quite important.
Sorry, and that actually was quite a common question. So do your ETFs have a DRP or dividend reinvestment plan, and why would you do it?
Yeah, so you can do that on the share registry, for example, where you can elect to dividend reinvest. The main reason you do that is you receive any distributions as units in the fund, because otherwise you might have received quite a small distribution in cash terms, particularly if you're starting out or you're early phase investor. You might receive that as cash, and then with that cash, you want to reinvest that back in the pool to grow, and that can mean incurring brokerage and transaction costs to reinvest it.
You're right.
So it's a cost saving for you as an investor to use DRP if you're trying to build your capital over time.
Yeah, great.
Which is sort of leads me on well to the next point when we talk about DRP helping you save costs. The other thing outside of targeting growth is just to be conscious of the effect that costs can have on your returns. So I just want to be clear, obviously cost isn't the only factor when considering making an investment, but by at least having a mix in your portfolio, I guess, of low cost index investments with maybe some satellites that might be a bit higher cost, you can lower the not insignificant effect that fees have on returns over time. You can see obviously I think everyone's sort of familiar with the idea that lowering your fees is one of the best ways to provide performance over time or increase your performance over time. I'll give you an example. A200, for example, is our Australia 200 ETF. It's sitting here at a 0.07 investment fee. That is so a $10,000 investment in A200, you pay just $7,000. You pay just $7 a year to invest in the fund. If that was a high fee active fund charging 1.5%, you'd be paying $150 a year. So you can save a lot annually by choosing a lower cost alternative.
It makes a huge difference, especially when you're starting out or in that accumulation phase where you've got a long time. Not only do returns compound, but that impact of fees as well.
So I guess just moving on to some strategies to consider in the accumulation phase, and one of those that you'll hear us talk to quite a bit in various webinars that we cover will be this idea of core and satellite investing. And that's the idea of building a low cost core and using smaller exposures that you might want to have to add a bit of what we call alpha or added performance to the portfolio. So for building a low cost core of the portfolio that's robust and targeted at the long term, you might use something like DHHF, our Diversified Growth Fund, as an all-in-one solution. Or you might, for example, use a small number of lower cost core building blocks like Australia 200 blended with our NASDAQ 100, use some fixed income solutions like CRED, our investment grade corporate bond fund.
And those A200 and NDQ NASDAQ 100 are simply just index tracking.
Yes.
Yeah, they're not attempting to.
these are designed to be low cost core exposures, right? Where one's your Australian exposure and one can give you global US exposure. And then, you might look at adding some smaller satellite positions around that are targeted more towards growth, but maybe riskier investments in terms of their volatility that we spoke to earlier. And this could be sector funds like HAC, our cybersecurity ETF that we've got up here, like Earth, our climate change ETF, or even, for a lot of people, it might mean having some select individual companies in the portfolio that they're interested in holding. The key point for long-term investors is just on managing the allocation of satellites versus the larger core portion of the portfolio. And that's probably the point I wanted to emphasize with new investors, is just making sure that you make sure that the core of the portfolio is robust and targeted for the long term, rather than getting out of whack and having the smaller satellites end up being, if you hold an individual company, it being a really big portion of the portfolio, and your diversified low-cost ETFs end up being smaller. You really want to make sure that the core is the bulk of your investment.
You're right. And I think just that next slide, just
yeah, this is just some of the funds I spoke to. You could all, depending on your investment experience as well, it's also might be interesting to look at different areas of your portfolio. I've got CRED here, our investment grade corporate bond fund. You'll find a lot of people, blending this into their fixed income part, who are a bit more dynamic with that exposure, to make sure they're getting a better yield off their fixed income than maybe some other core bond products that hold a lot of government bonds that don't yield as much. If you've got a longer term time frame, you really want to be optimizing that part. But that's sort of getting a bit more advanced, but it's something to think about.
And you mentioned at the start of the session, you're rebalancing, you're reweighting. So what your allocation is at the start of your accumulation phase is going to be different as you're coming to the end of it.
That's, a really good point. Something I maybe didn't touch on was just also with accumulation, you really want to make sure that your portfolio is evolving over time as your needs are changing as well. That's where you might start with an all growth fund, and then you might shift to a balanced exposure, or you might add some more defensive assets over time to your portfolio to just shift that asset allocation. Someone who's moving into the transition to retirement, they've probably moved more towards balanced, as opposed to when they were starting out, they might have been growth or high growth.
Mm-hmm. Yeah, good point. And just our final stage,
retirement.
Long and happy, hopefully, and well funded.
Exactly, happy and well funded. That's the goal for everyone here. Look, the biggest change for retirement is that you're drawing down from your super rather than accumulating in your super. The one thing that we spoke about, allowing your portfolio to evolve over time in the accumulation phase. It's pretty similar with retirement. It's important to understand that retirement is a process. It's not a single point, and hopefully it's a long period. And so portfolios still need to evolve and change over time as you get older, but also you're still likely to see a number of market cycles. So what that means is you still need to balance having growth in the portfolio, but you're also increasingly, need income in the portfolio and liquidity to manage the drawdowns that you're going to have to fund your lifestyle. And so simple things we spoke about, dividend reinvestment plans. This is the time where you may want to move from having a dividend reinvestment plan to actually receiving the distributions or dividends from your stocks or your ETFs. Now, the difference from an investment standpoint is you now probably want to start looking towards funds which are more targeted at generating income than on capital growth. And also, as you get older, you may need to really start to assess the ability of your funds and your capital to tolerate big drawdowns in the market. And so that's where you might consider things like managed risk equities funds. And so I've got a couple of examples here of funds you might consider. Hybrids, for example, are interesting. Something you might consider is chances are in your Australian equities portfolio, just by nature of what we see a lot with the way Australians are invested and even the way our market is, you might have a lot of bank shares. Something you might consider doing is moving some of those bank shares into bank hybrids. So bank hybrids are higher up the capital structure, so we say. They tend to be lower volatility, but importantly, they also pay out a franked dividend yield and traditionally a higher dividend yield. So that's something you might consider. We often see people doing is just changing their equities mix and using something like hybrid securities. You may also, when I spoke about funds that are targeted more towards income, this is where you might look at moving some of your core equities into something like an equity income product, where they're specifically targeted at high yield equities. Our equity income product's actually an active ETF where we use a fund manager looking over the portfolio, making the decision on what to invest in, and ultimately what they do is they're actually running the ruler over the underlying companies on the Australian market and making their assessments on not only the dividend yield that those companies are paying out, but also things like the sustainability of that dividend yield and the ability to maintain that income over time. And that can be really important as well. So, using something like e-ink as opposed to alongside a core Australian equities exposure. And then you might consider things like we have two funds, UMax and YMax, which are our yield maximizer products, one for Australia, one for the US. And they use strategies called a covered call strategy, a very basic option strategy to generate additional income off your underlying equities holdings. They traditionally tend to be lower volatility, they don't have as much capital upside as just holding the equities, but they're going to deliver you more income. And the last one I mentioned earlier, and this is something to consider as you potentially your retirement and your portfolio evolves over time, is managed risk strategies. Now, a managed risk strategy is not something that you'd probably look at as a person in your 20s, but as you're getting further into your retirement, what a managed risk strategy allows you to do is still hold a basket of equities, still be entitled to the dividends, still be entitled to the franking credits as an Australian investor, but they use a risk management strategy to lower the volatility in the portfolio, and importantly, to hopefully manage the drawdowns in the portfolio, particularly those large drawdowns, the kind of things that we see in GFC type events and COVID type events that tend to be quite large, meaningful, longer drawdowns.
Okay, and you keep mentioning drawdowns. Drawdown is simply just selling.
Yeah.
To realize,
Yeah. So just to be very clear, drawdowns, I've probably mentioned it twice in different contexts.
Yeah.
There's drawdowns in terms of drawing down capital from your portfolio. What I meant by drawdowns is a market pullback.
Right. Yeah.
So can your portfolio survive a market pullback?
Yeah. So if you were in the unfortunate circumstance where you had to sell at during the global financial crisis, or when the market was going through a low period, I think it was last December, or so that if you were forced to do that would have had a really big hit on your portfolio. But it just means drawdown in that second circumstance is just selling your shares or selling your ETFs to get the money.
Drawing down on your capital to pay for your lifestyle. Two slightly different uses of the same term there. I can understand that can be confusing, but yeah, so it's just about can you really afford to survive a major market pullback if that went for 2 years? In that 2 years, you were constantly having to sell down assets to pay for your lifestyle at much lower values than maybe they might have been before and might end up being afterwards.
Okay. And then the next slide really is just that sort of illustrative example of the products you went through. Now, can we just wrap it up in a sort of summary of each stage as you went through?
Yeah, so I guess to as a summary, starting out, we're talking about starting out your investment journey with, or building a portfolio of assets out of your personal income outside of super. Things you need to consider when investing that way. That's things like investing regularly, targeting diversification, and for us, using efficient products is probably the key takeaways from that. Accumulation, I was very much obviously talking to people's super there. Increasing, making regular contributions, which you do anyway out of your income. Big ones are making sure that you've got the right risk profile for your investment time horizon and your point in life. Diversifying again, but also targeting growth and managing costs were the two ones there. And retirement. Making sure that understanding that retirement isn't just a point in time, but shifting, I guess, to some specifically targeted at retiree investors, and that's high income strategies and even potentially things like managed risk strategies, and enjoying the benefits of what you've built during the accumulation and starting out phase.
Yeah, and I think the point you mentioned before about diversification and investing regularly, not being applicable to all stages, or being applicable to the starting out and accumulation.
Yeah.
So it's not one applies to one and not the other.
No, there's a lot of crossover between those two stages. Where I've sort of delineated a little bit, and what I spoke to is maybe investing in your personal account with specific goals, and investing your super fund with the goal of building your capital for your retirement nest egg.
Okay, and just a few things to consider before we jump into the questions. We've got a little bit of time for questions, which is always nice. I mentioned at the start of the webinar, we were speaking about general concepts in nature. Portfolio values can go down as well as up, and there are risks with investing. There are no guarantees, unfortunately. General information only. Professional advice. Before you make any investment, you should seek professional financial advice and do thorough research. PDS, which is a product disclosure statement, is available for all funds and is available on the product page on our website, where you can find additional information such as fact sheets, brochures, flyers, and other information. A lot to consider before investing, so great that you are here building up that knowledge and other things to think about. Now we've got some time for some questions. We'll just jump to, okay. So this is a good one. How often should I be buying and selling investments? Is a set and forget approach viable?
It is a good question. It's one we get a lot. I think I covered this a bit when I was talking to starting out, and really the idea, I can't emphasize this enough because very much believe it, that time in the market beats every day. I cannot emphasize enough how difficult it is to time the market consistently, and that's why, as I covered, investing regularly and almost, I guess, methodically pays off over time, as opposed to maybe jumping in and out of the market at different times, based on whether you think the market might be too high or whether it's a buying opportunity or things like that.
Isn't that a good endorsement of that core and satellite approach? Some people actually really enjoy the process of investing, and it's almost a hobby. I mean, the rise of the Robin Hood investor and the Reddit, it's actually a pastime for people. So if you were to have that really solid core, I mean, is there anything to stop you from?
Exactly. I think it's that's where the core satellite approach is so critical, is invest regularly, build out a solid core that's designed to be a long-term investment, and then by all means, invest around the outside with smaller parcels, to try and target some, what we call alpha, try and target some extra returns.
Yeah, that's a good one. Why are ETFs replacing managed funds?
Probably could cover that one a little bit at the start. I mean, I'll say it over time and again that an ETF is just a progress in technology. Managed fund is a bit of an old system, or a traditional managed fund is a bit of an old system where you had to apply directly with a fund manager. Oftentimes it can take quite some time to receive the funds from your redemption. It's just a bit of a clunky process. An ETF is just where someone came up with the idea of, surely there's a better way to transact and buy and sell units and enter and exit this fund than what exists currently. Why don't we use the stock exchange to do it? That's really how it started.
Yeah, and I think ETFs have been around in Australia for 20 years.
Yeah.
So we've even seen that evolution of the actual funds themselves, and the diversified funds you were talking about, ETFs of ETFs, are only relatively new.
Yeah, I mean, that's what we sort of covered last time we spoke in our evolution of ETFs, but they're sort of the next step in ETFs, where you can just buy a diversified portfolio in one transaction now.
Yeah. We had quite a few similar type of questions, and it's looking. I'll just read the question. There you go. Is picking international ETFs worthwhile for an SMSF, given less or no franking credit benefits?
It's a good question. It's one I sort of touched on there, and I don't really want to get in the realms of tax advice and investing in a tax efficient environment.
No.
Like super. That being said, it's just important to get the balance right. If you're in accumulation, it's just making sure you've got a mix of regions, solid diversification, at what we call the intra-asset class level, so within your equities, and naturally offshore markets tend to have, particularly the US, a bigger weighting towards what we call growth sectors and growth companies, a lot of consumer businesses, a lot of technology businesses than our own market. And so oftentimes, we see this, that investors in accumulation are focused too much on dividends and franked dividends, can often be missing out on the returns generated by companies that aren't necessarily as focused on paying out dividends, but are focused on reinvesting their profits into the growth of the company. That's one thing to understand, is a company that's paying a high dividend is traditionally a more mature business. They're not necessarily focused on growing anymore. They're focused on paying out a dividend to investors, paying out their profits. A growth company is a company that reinvests its profit back into itself to make itself effectively keep getting bigger and growing the capital pie.
Yeah, right. That's a good one. And a question here about, can you give us some examples of growth funds and defensive funds?
Yeah, so a growth fund would be something like, you can get something like hacker cybersecurity ETF. That's where you're looking at companies that are in very much early stage. It's an early stage sector. There's a lot of structural tailwinds. These companies are very much positioned for in a growth area, and they're companies that are focused more on growing their businesses. Defensive is what we call the defensive part of your portfolio, is the part of the portfolio that you use to lower the volatility of the riskier assets. And so that's the defensive part of your portfolio, is things like bond funds. Cash is included in the defensive part of your portfolio. And what that means is, I guess, it zigs when the market zags. So bonds will traditionally rally, as in what's called a safe haven asset.
Yeah.
In a market sell-off. So it's that part of your portfolio that will either remain sound, it's lower volatility, or even rally when your equities sell down.
And so you could sort of group that and to fixed income if you're looking at those bond and cash. If you were to look on our website, you would see that there is a section for fixed income if you were looking at examples like that. And then you mentioned HAC, which is our global cybersecurity ETF, a sector.
Yep.
And then we've also got other sector ETFs such as robotics and AI.
Yeah, we've got robotics and AI, cloud computing, Australian technology, Asian technology.
Yeah.
These are traditionally sectors where your goal in investing in that sector or in those companies is capital growth and to profit from the growth of those sectors, as opposed to your goal being to invest in those companies because, to try and get an income stream from them, because the majority of them don't traditionally pay out a dividend or much of a dividend.
Yeah. Another question here on the frequency of distribution for income products. How often will I get paid?
Varies. Our bond products are monthly.
Okay.
Our cash products monthly. Our dividend harvester fund is monthly. Some might be quarterly, some might be semi-annually. You just need to look on the fund website when doing your due diligence to see how frequent the distribution for that ETF is.
So generally speaking though, if a fund was targeting income, would you expect it to pay distributions more frequently?
Some of those, we do make a decision with some of our funds to distribute a more regular income stream.
Okay. What is the difference between, and this is something we definitely covered in our introduction to ETFs, but love that it's come up again, difference between active ETF and a managed fund?
It's a managed fund, it's getting, I guess, down to the discussion between the difference between a managed fund and an ETF. An ETF is a managed fund. Often a managed fund can also be an index fund, but an ETF is a managed fund that's traded on the exchange. Now, the difference between an active ETF and an ETF or an active ETF and I guess a traditional index ETF is the traditional index ETF doesn't have a portfolio management team making subjective decisions on the underlying securities in the portfolio. Traditionally, because of that, they will be lower cost. An active ETF will have a management team making those decisions, looking into the underlying securities and deciding what goes into the portfolio. So traditionally, you pay a little bit more for that. Oftentimes, where we have active ETFs is in parts of the asset class mix or within asset classes where we think that active managers can provide value or are necessary. Australian high yield, for example, we think that the active management strategy can often yield better results than some of the passive alternatives out there. Emerging markets is one, for example, where an active manager can provide a lot of value by assessing the companies in what are more opaque markets. The other thing with some active ETFs is just the transparency as well. So bearing in mind that with a traditional index ETF that doesn't have an active label, you can see every day the holdings in that fund. With active ETFs, particularly active equities ETFs, the bulk of those are non-transparent for obvious reasons. There's, intellectual property in the underlying strategy of the fund and the underlying holdings. And so the manager won't publish the securities they're buying every day. And there's also some market making differences between active and passive, which again is another layer probably for a different discussion.
Yeah, absolutely.
But the point would be that, there's really no difference to the end investor.
You can, of course, find a full list of all of our funds. And I just realized we didn't actually do our intro about BetaShares, but we've got 63 funds listed on the ASX, covering all asset classes. So, as Adam dived into defensive, growth. We cover them all: international, domestic, currency, active. 63 funds. You can find that fund list on our website if you just click on the Our Funds tab on the top navigation. You'll find that full list there. We've probably got time for one more, and I think I know where the answer is going to go, just in terms of that risk tolerance. But how do you change your allocations the closer you get to retirement? So how do you mitigate the risk on your portfolio? How do you bring it down?
Okay, you can change your risk profile by adding more defensive assets. So if you manage your own investments, you would traditionally look to reduce your exposure to riskier assets like equities and add more defensive exposures into the portfolio. If you use a default super fund, you might just change your risk profile as you approach retirement from high growth down to growth, down to balanced, even to conservative. And if you do invest in diversified ETFs, you might just change the diversified ETF that you invest in.
Yeah. That's great, Adam. And I mean, so many of the questions were really about what to invest in my 20s, what do I invest in when I'm 25, what do I invest in when I'm 30. I hope we've covered the fact that it is individual to you. It changes. Getting started is the important thing, but also it's something to be reviewed and looked at over time. I mean, any closing comments, Adam?
Hopefully I've covered a fair amount of it through the discussion, but start early, invest regularly, diversify, and let the market do its thing. And
have that long, happy, well-funded retirement.
That's the goal.
Thank you so much. We've really enjoyed bringing you this session today. We hope you have learned something and enjoyed. If you've got any comments, please leave us some feedback. We look forward to talking to you at our next ETF session. Thank you very much. Stay well and goodbye.